Alright, hi everybody. Today we're going to talk about a French luxury empire that very few investors are talking about and seem to have on their radar. So which business am I talking about? We'll reveal it in just a second. Let's go. Alright, so the business we are going to talk about today is called Kering. And Kering, as I said earlier, is a French luxury group that owns quite a few brands that you will probably have heard of. And I'll get to that in just a moment. But before we get to the overview of the actual business, let me just show you how the stock of Kering has performed over in the more recent past. So as this chart here shows, over the last 5 years, from its previous peak, the stock is actually down and is astonishing 71%. So at one point, it was trading close to 800 euros a share. And as of today, the time I'm recording this video, it's trading in the range of 220 to 230 euros a share. What I also found amazing, and I tweeted about this right here, is that even if you zoom out and take a look at the last 25 years ballpark, the stock hasn't really delivered any satisfying returns. This is just the price return and not taking into account the total return. That is then again also adding the dividends the company paid to shareholders over time, or is taking this into consideration as well. But nonetheless, and to be fair, someone pointed out that the business today is a fundamentally different business than it was, say, in the early 2000s. Nonetheless, I found that surprising because, as I said, you will know and will have heard of many of the brands that the Kering Group actually owns. And I would have expected this company and this group of businesses or this group of brands to do much better and to create more shareholder value. So what does Kering actually do? Again, you can see the Koifin business description over here. I highlighted a few aspects here. So first of all, it really is a massive company with almost 50,000 employees. The company was actually founded many, many decades ago in 1963. However, I actually created a slide for this as well. The history of this business is actually quite interesting. And to be fair, I think the most important date in the business's history, or the most important year, was 1999. Because in 1999, the company actually acquired a stake in Gucci, which was basically the first step in creating this multi-brand luxury empire the Kering Group is today. The market cap right now is 27 billion euros, and the enterprise value is actually significantly larger, which we will get to again when we talk about the valuation of this business. So basically, on this slide, you see the most important brands that this company owns. We've got Gucci, which, and I highlighted this here, over the last 12 months, generated an operating margin of around 25%. Then the second big brand under the Kering umbrella is Yves Saint Laurent. This business, again, is generating a similar operating profitability, generating an operating margin of 22%. Then we've got Bottega Veneta with an operating margin of around 14.5%. And then we got the other brands, which they summarize under the other houses umbrella. And some of the brands that you might have heard of would, for example, be Alexander McQueen or Balenciaga, which I assume, at least after their marketing scandal 1 or 2 years ago, many of you will be familiar with, because basically this company made negative headlines all over the place. What I would argue is that the margin profile of these different brands and segments also reflect the maturity of these brands. So while Gucci and Yves Saint Laurent are certainly the more mature brands Kering owns, other brands like Balenciaga are probably going to be the brands that are going to drive more growth going forward, just because the growth runway is a lot longer for these businesses. However, this also means that the company can reinvest more heavily into growing these brands, primarily via marketing investments. So this is what I was trying to highlight on this slide here. As you can see on the very right, I would consider the quote-unquote other brands the major growth drivers going forward. Of course, the more mature brands, hopefully, and that would be part of the investment thesis, are able to grow over the long term as well. As you will see in a second, over the last 12 months and the more recent history, these businesses have actually generated less profits, less revenue than they did in the past. And for luxury business, it is generally a very fine line. Are they going to grow via volume increases or via price increases or a mixture of both? So I would argue that the challenge for these luxury brands is always to remain the right level of exclusivity, which means they can only grow their top line and profits via volume increases so far, because if they increase the volume too much, well, then all of a sudden the brand might no longer be perceived as exclusive as it should be, which in turn would translate into pricing power. So my perception, for example, would be that Gucci has, over the last 5 years or so, lost some of its status as really an iconic luxury brand and really one of the top 4, I'll show you a table on this topic in a second as well, one of the top 4 luxury brands in the world. Of course, Gucci, which primarily is selling to consumers via their own retail stores, but they are also selling through some wholesalers, which sometimes offer a discount. And offering discounts is something that all of the LVMH brands, for example, don't do it. MS doesn't do it. And it's something that can harm the public perception of a brand. All of a sudden, it's becoming more of an aspirational luxury brand than what is sometimes referred to a true luxury brand that is extremely exclusive, which of course comes with a certain price tag as well. Maybe 2 more things in terms of the brands that are owned by Kering. I want to highlight 2 more brands here that I haven't talked about yet. So first of all, not too long ago, Kering actually acquired a 30% stake in Valentino, which is also a well-known brand, and the company paid, I think, a multiple of around 16 times EBITDA for this business, or for this stake in the business. And then they also acquired Creed, which is probably mostly associated with luxury in the fragrance space. I'm not entirely sure how much they paid for this brand, this company, but I'm not sure. Someone pointed out they might have overpaid for it, but then again, I'm not sure if you can really overpay for what is perceived the luxury fragrance out there. All right, what you can see here is the table I was referring to earlier. You see the most valuable fashion brands. Gucci, which is, and I'll get to that in a second too, is the most valuable, most important brand under the Kering umbrella, is basically the 4th most valuable luxury brand in the world, only behind Louis Vuitton, MS, and Chanel. Which already brings me to the competitive environment that Kering is operating in. Obviously, the big boys, the big players you have to be aware of is the LVMH group, which is much bigger. It's generating revenue of around 86 billion euros compared to around 17, 18 billion euros generated by Kering. And of course, Louis Vuitton is also much more diversified in terms of the categories they are operating in. Kering is much more focused on the fashion sector, while Louis Vuitton also operates in the leathers and goods segment, fragrances, jewelry, and so watches, much more. Then the other ones you have to be aware of would be Richemont, or Richemont, I always struggle with the pronunciation here, MS of course, Chanel, and then some of the smaller groups to be aware of in terms of the revenue they generate. Those would be the Prada Group and Burberry. And I think what's also important to understand as an investor who is looking at Kering as a potential investment is to understand where Kering ranks in that competition. So I would argue that at least LVMH is perceived to be a higher quality collection of quality brands, luxury brands, and MS plays in a completely different league. So I would argue that MS is probably the most true luxury stock you can own when it comes to fashion, leather and goods and things like that. All right, next up, just a few words on the management team right now. So what's really important to understand is that the Pinault family still owns 42% of all shares outstanding. So chances are the management incentives are very well aligned with the interests of shareholders, because they are also going to make sure that the brands and the business remain intact over the very long term. The company is currently run by the founder's son, by François-Henri Pinault, who is also the director of the business for whatever it's worth. And generally speaking, and I should clarify that I only recently started looking at this business, so I'm still in the process of learning more about Kering. But generally speaking, it seems like we have a management team, as I said, that is well aligned with your interests as a long-term shareholder. Let's take a look at the financials of the Kering Group. So I already said that Gucci is sort of the crown jewel of this business, and this is reflected in the numbers. So over the last 9 months, for example, if we look at the financials here, the first 9 months of their 2024 fiscal year, we can see that Gucci represented around 44% of the overall revenue of this group of brands. And if you take a look at the financials from a profit point of view, thinking back of the different operating margins, generated by the different segments, then Gucci becomes even more important. It will represent, or it does represent, more than half of all profits. Actually did the math for the 2023 fiscal year, for example, and you can see the numbers right here on screen. In the 2023 fiscal year, Gucci accounted for 68% of the group's operating profit. So an investment in Kering is certainly an investment in Gucci as well, and a bet on a potential turnaround when it comes to the perception and revenue generation capabilities of this brand. Because as you can see right here, Gucci right now and the Kering group are struggling. So what you can see here, for example, would be that in the third quarter of the 24 fiscal year, revenue is actually down 15% compared to the same quarter in 2023, which again is showing that probably even the wealthier cohorts are showing some price sensitivity in the sort of high inflation environment we've all been living in for the last 2, 3, 4 years. And the numbers for Gucci specifically look even worse. So as you can see, Gucci's revenue is actually down 26% compared to the third quarter in 2023. And this can largely be, you can see this on the right, be attributed to weakness in Asia, the Asian world, and China specifically, which is actually why many of the luxury stocks have been struggling more recently, have come under pressure. Many of these stocks have a pretty high exposure to the Chinese economy. And due to the poor business consumer sentiment in China, well, many of these businesses have been struggling in terms of their business performance, their overall business performance, because the business performance is pretty reliant on the Chinese economy doing well. So here's another chart on this subject. As you can see, in the Asia Pacific region, the Q3 revenue is actually down 30%. Which brings me to another point that I wanted to make here. Generally speaking, and you can see this on this slide here, this business actually enjoys pretty high operating leverage effects because they have quite a fixed cost basis, because most of their sales are conducted via their own retail stores. So 75% of the group's revenue has been generated by selling clothes, fashion, leather goods through their own stores, which again represents, as I said, a fixed cost structure. Now, if all of a sudden the foot traffic in Asia, for example, goes back by 20 or 30%, but your fixed costs, your rent, your personnel in these stores, your staff in these stores, electricity, maintenance, all of this remains the same, which will in turn impact your profits. So all of a sudden your profits will go down. And earlier I said, I think Gucci right now represents or generates profit margins, operating profit margins of around 25%. Historically, the business has generated much higher margins. I think at one point generated profit margins, operating profit margins of around 36%. So all of this shows that the business is under pressure right now, and management needs to find ways to turn things around. Right here, just again to add some more context, overall, the business owns around 1,800 retail stores, and here you can see an overview of how many stores they own in the different regions. As you can see, especially in the Asian world, they own close to 700 stores. All right, so we are still talking about financials. What you can see on this slide right here is the margin profile of the business. And generally speaking, I'm interested in the luxury space and the luxury sector because many of these businesses generate almost software-like margins, and especially gross margins in the high 60s, low 70s percentage range. And this is true for the Kering group as well. As you can see, over the last 12 months, the gross profit margin stood at 75%. However, and this is what I talked about just a second ago, seeing operating leverage in reverse, there's something to worry, because at some point operating margins were as high as 30% back in 2020. Even as late as in late 2022, the business posted operating profit margins of 28%. Over the last 12 months, however, operating profits came down to under 20%. One final comment I wanted to make here in terms of the financials of the business is shown in, or is based on the slide you can see right here. What sort of worries me a little bit or makes me less interested in the stock idea is the current payout ratio of the Kering group. So as of the last 12 months, the payout ratio was as high as 82%, which is of course to be attributed to the fact that the net income margins also came down, meaning the dividend the company is paying to shareholders will all of a sudden represent a larger portion of that net income. But what I will say, and that's something that I also addressed in my recent video on Evolution Gaming, generally speaking, I like to own businesses that just have a very high reinvestment rate, meaning most of the profits generated by the business can be reinvested back into the business, ideally at high rates, which will truly get that quote-unquote compounding machine going. And once the business starts paying out most of the profits, well, you will no longer get that internal compounding effect that long-term investors should be looking for. But nonetheless, let's talk about the investment case here and valuation. So I read this interesting quote here in one of the many write-ups I read on the Kering group. Luxury brands compound in value over decades rather than quarters. And personally, I actually have a pretty good feeling in terms of where these brands will be 10 years from now compared to where they are today. I think chances are they will generate more in revenue than they do today. I think the brands are perceived at least as premium brands, but that's also an important distinction. Premium brands usually have much less pricing power than companies that are really perceived as true luxury. So that is something you also have to assess, but I would argue that many of these brands can be perceived luxury, at least aspirational luxury, which in turn should give the business pricing power. And arguably, it's best to buy into these businesses when there are some worries. As right now, when the Chinese economy is struggling and there's some weakness in demand, which is reflected in the numbers. But will things turn around in Asia? I think chances are yes, they will. And then I think there will be higher demand for some of the Kering brands again, which will probably then lead to a reversal of the effects we've been seeing more recently. I think revenue will pick up again. Chances are we will see higher profit margins again. And then again, the stock might be re-rated as well. But again, the big question here is this sort of a cyclical challenge that the business will have to overcome, or is it a more structural one in which the brands really are at risk of becoming less valuable? I think what's really important to understand when you bet or invest in a luxury stock is that maybe the second most important role beside the CEO would be the creative director or the creative directors of the various brands owned by this business. And Gucci, and I would encourage you to read a couple of articles on that transition they're going through right now. They have a new creative director called Sabato De Sano, and I actually highlighted one passage from, I think it was a Vogue article, yeah, exactly, that I read on De Sano. So my understanding would be that he's trying to transition the Gucci brand into more of a timeless, more minimal, quiet luxury brand than it was in the past. And that would be something I would like to see, because this will reduce cyclicality. Cyclicality will probably increase demand among a wider audience. Yeah, and of course, I would like to know how you perceive the Gucci brand right now and what you think of a potential quote-unquote turnaround when it comes to how this brand is perceived by the broader consumer base. Then I guess another part of the investment thesis in Kering would be the opportunity in beauty. So more recently, the house or the group actually launched the Kering Beauty House, which means they're going to launch beauty products or products in the beauty segments under the various brands owned by the Kering group. Chances are that there will be demand for these products. As they write here, they will be able to leverage the perceived brand status by many of these names, and this should be able to boost revenue a little bit, help revenue a little bit over the next couple of quarters. Which brings me to valuation. So there are various ways to value Kering here. For example, you could do a sum of the parts valuation, in which you would assign a specific multiple to the profits generated by the different businesses. You could, of course, run a DCF as well. You could do an exit multiple approach here. The way I approached it here was the following, and that would be the bold thesis. Full transparency again, I'm not a Kering shareholder. I have no intention to buy a stake immediately. I'm taking it into consideration, just like I consider investing in Evolution Gaming. But then again, I also have only a cash position of around 3% right now. But as of today, I'm not a Kering shareholder. And I want to acknowledge that what I'm going to explain right now is sort of the bull case. And I don't have the conviction yet that this bull case will materialize. But the bull case would be that, of course, If the management team, with the help of the new Gucci creative director, is able to turn things around, this would lead to increase in revenues for Gucci specifically again, which again would translate into higher operating profit margins, which would also elevate the operating profit margins and of course the net income margins, the free cash flow margins of the entire group as well. So over the last 12 months, for example, the net income margin of the Kering group only stood at 11%. If they can get that margin back to say 15%, well then all of a sudden the company would no longer trade at a forward 18 times earnings multiple, but on a quote unquote look through earnings multiple of around 10 times, which is probably too cheap for this basket of luxury brands. However, and this brings me back to something I said earlier, obviously now we are valuing Kering on a market cap basis. As the comparison between the market cap and the enterprise value showed, Kering also carries a significant portion of debt. And once you acquire a stake in a business, you are also acquiring the debt load. So that is something you would have to take into account as well. And so if we value Kering on an enterprise value basis, it's not as attractive of an investment case as it would be on a market cap basis, which is why I will probably remain on the sidelines for a little longer. I'll have to do some more research again, try to build the conviction to become an owner in this business, and I'll keep you updated on that, I guess. What I've also considered would be to place more of a basket bet on the entire luxury segment by investing in companies like Kering, LVMH, and Moncler is another business I currently have on my watch list. So again, feel free to tag me on Twitter to ask me whether I have taken a position anytime soon, anytime in the next few weeks. And of course, I would love to hear what you think about this potential opportunity as well. So please share your thoughts in the comments down below. I'll see you in one of my next videos. Take care.